For a very long time, people have been told that budgeting is the smartest financial habit a person can develop. Many Americans grew up hearing the same advice repeated over and over again by parents, teachers, and television experts, all saying that the road to financial freedom begins with carefully tracking every dollar that comes in and every dollar that goes out. That advice sounds responsible, but when you step back and examine the math behind wealth and financial freedom in today's world, something strange begins to appear. The strange thing is that millions of people have been budgeting for decades, yet most of them are not financially free. According to surveys from the Federal Reserve and other financial studies, nearly 60% of Americans say they are living paycheck to paycheck. This means the majority of people in the richest country in the world still struggle to build real financial security. If budgeting truly worked the way people claim it does, that number should be getting smaller every year, don't you think? One of the problems is this. Budgeting focuses almost entirely on controlling spending, which means the main goal becomes cutting expenses wherever possible. However, expenses have a natural limit that cannot go much lower once basic needs are covered. People need housing, food, transportation, insurance, healthcare, and electricity, and those costs alone take up a large portion of most household incomes in the United States. Take, for instance, a worker earning around $60,000 a year, which is very close to the median household income in America today. Suppose that person decides to follow strict budgeting rules in order to improve their finances. They cancel a few subscriptions, cook more meals at home, limit eating out, and reduce small purchases like coffee or convenience store snacks. After all that effort, they might save $200 each month, which equals about $2,400 a year. That sounds like a good step forward, but now take a wider look at the numbers. Let's say that the same worker receives a $10,000 raise. Something interesting happens. The $10,000 increase in income equals more than 4 years of the $2,400 saved from strict budgeting. This means one single improvement on the income side of the equation completely overshadows years of small spending cuts. If that is not a powerful example of how money really works, I do not know what is. Budgeting often trains people to focus on small expenses, such as grocery bills, streaming subscriptions, and coffee purchases, while the larger financial factors receive far less attention. Yet those larger factors ultimately determine the outcome of a person's financial life. Income, investment growth, and ownership of productive assets have a far greater long-term impact than saving a few dollars on everyday spending. If a household that already spends most of its money on necessities continues cutting expenses each year in pursuit of financial freedom, it eventually reaches a point where there is simply nothing left to reduce without significantly lowering the quality of life. At that stage, the strategy runs into a wall where progress stops entirely. Income growth, however, does not have the same hard limit. A person can develop new skills, move into higher-paying work, start a side business, invest in productive assets, or participate in industries that are expanding rapidly. This difference between cutting expenses and increasing income explains why budgeting often produces very small results compared with strategies that focus on growing income or building assets. The contrast becomes even more noticeable when investment growth enters the picture. Money invested in productive companies or assets can grow over time without requiring constant attention from the person who owns it. For context, the S&P 500, which tracks many of the largest companies in the United States, has returned roughly 10% per year on average over the long term when dividends are included. Under typical historical conditions, money invested consistently in broad market investments could double roughly every 7 to 8 years. When someone builds assets that grow in this way, financial progress begins to accelerate in ways that budgeting alone simply cannot match. For example, consider someone who invests $500 every month into broad market investments for 20 years, with an average return close to the long-term historical performance of the stock market. After 2 decades, the total investment could grow to more than $300,000,
even though the individual contributed only $120,000 of their own money. The difference between the contributions and the final value comes from growth and compounding, which is one of the most powerful forces in finance.
Now compare that outcome with someone who spends 20 years carefully budgeting small expenses, but never builds meaningful investments that grow over time. Budgeting may help that person avoid unnecessary spending, but it does not create the strong upward momentum that comes from owning assets that increase in value. This is why many financially successful people focus far more on increasing income and building assets rather than obsessing over every minor purchase. In fact, the real reason budgeting continues to dominate financial advice is largely because of psychology rather than mathematics. Tracking spending feels productive, even when the long-term results are relatively small. When people organize their numbers in a spreadsheet or a budgeting app, they experience a sense of control over their money. That feeling of control can be very satisfying, even though the strategy itself may not be the most powerful path to financial independence. However, when people step away from the budgeting mindset, an important realization appears quickly. Financial freedom is not really about controlling every small dollar that leaves your wallet. Instead, it is about building systems that bring larger amounts of money into your life over time. The people who eventually reach financial freedom rarely get there because they perfected a spreadsheet that tracks every grocery purchase. They get there because they build income streams, own productive assets, and place themselves in positions where their money can grow faster than their basic living expenses. At this point, the conversation shifts from budgeting to increasing the amount of money that can be invested consistently over time. When income rises, the amount available for investment can rise as well, which allows financial progress to accelerate much faster. A person earning $80,000 a year has a much easier time investing meaningful amounts of money than someone earning $40,000 a year, even if both individuals have exactly the same spending habits. This is exactly why economists and financial planners often emphasize income growth as one of the most powerful tools for improving long-term financial outcomes. In simple terms, the economy rewards productivity and innovation far more aggressively than it rewards extreme frugality. For example, consider the technology industry in the United States over the last 20 years. Software engineers, cybersecurity specialists, and data analysts have seen their salaries increase rapidly because demand for their skills has expanded across many sectors of the economy. Workers who moved into those fields often experienced salary growth that far exceeded anything budgeting alone could ever produce. Some entry-level salaries in these industries now exceed $70,000 per year, while experienced professionals can earn well above $100,000 annually, depending on their role and location. This level of income can provide the financial room to invest in other areas that may ultimately lead to financial freedom. Speaking of investing in other areas, real estate is one of the most powerful places to invest. Rental properties can generate monthly income once expenses are covered. Property values may also increase over time, depending on location and economic conditions, which adds another layer of financial growth for the owner. Millions of Americans have built long-term wealth through real estate ownership because housing remains one of the most important sectors in the economy. As a matter of fact, the median home price in the United States has risen significantly over the past several decades. It increased from around $80,000 in the early 1980s to more than $400,000 in recent years, according to housing market data. While housing markets move up and down over shorter periods of time, long-term ownership has historically created substantial wealth for many homeowners. All of these examples highlight the same fundamental idea that runs through modern finance. Ownership and growth create far more financial power than endless expense cutting ever could. Budgeting might help someone stay organized, but it rarely changes the long-term trajectory of wealth in the same way that income growth and asset ownership can. This does not mean spending should be reckless or irresponsible, But the obsession with budgeting often leads people to believe they are doing something extremely powerful when the actual financial impact remains relatively small. If you found this video eye-opening, support us by subscribing to our channel and giving this video a like. Also, check out other analytical financial videos like this on our channel. See you there!